Hey, welcome to the May 2022 Investment Strategy Brief. This month we're going to jump into this concept of where we're headed with the economy and, of course, on a related note on the markets, but really capture it with this idea of whether we're going to be able to achieve a soft landing with this shift in Fed policy. Now, really, as it relates to the environment, we all know here in 2022, we've been really dealing with increased volatility, amplified uncertainty. And what I want to do to start is really take a look at some of the elements and sort of factors that are driving increased volatility. So here we have basically a set of issues that we know are in focus, right? There's everything from elevated inflation to the unfortunate war in Ukraine with Russia's invasion there. We see things like sort of friction in supply chain, sort of resulting from that war, for example, and adding to inflation. This has caused the Fed to have to make a shift in policy, so the uncertainty about exactly where the Fed's going to go is certainly in focus here. And by the way, as it relates to volatility, usually election years and especially midterm years are a little bit more elevated than normal. So the midterms, what's happening in DC has an effect. And all of this sort of rolls up to the basic question, when are we going to see a recession? And is it going to happen anytime soon? So we're going to jump into that. As it relates to market volatility, we've sort of expanded the chart this month to kind of look at a few additional things. So on the left here, the S&P 500, basically a move up since the bear market of the pandemic, and then now a move down almost to basically a bear market territory for the S&P 500. In turn, with Fed policy changes, which we'll get into, the 10-year Treasury rate has moved up. That's having some market implications we'll also talk about. In any event, two popular volatility indices, the VIX for equities, and you can see a bit of a jump here in 2022, and then the MOVE index, which really relates to interest rate volatility, which, of course, in the current environment with rates going higher, means that bonds prices are down. Another thing weighing on everyone's mind, unfortunately, is the Russia-Ukraine crisis. So the war in Ukraine as Russia's invaded there. And, again, the way we think about it is we know when this happened, it was a bit unexpected. We all took stock in what was going on in terms of Russia's exposure to the world, how it provided energy to Europe. It's basically a producer of precious specialty metals and things like that. And essentially, even the U.S. buying energy from Russia through policy, et cetera, basically sanctions, everybody's sort of pulling back from engagement with Russia. And while it's, in theory, there's ceasefire talks going on, it's still a very difficult situation. We've sort of updated our scenario analysis to really three scenarios as we've newly defined it. One is an abrupt resolution. This would be the most positive. But bottom line is it's probably not going to happen. We'll see. A prolonged war where it takes a lot more time to get through this, and that could have some impacts on things like commodity prices, et cetera. And then scenario 3 would be a prolonged war, but with increased NATO involvement. That's the most negative, I think, of the three scenarios that we're monitoring. So just know that we're monitoring the war and its implications on people, of course, and on the global economy and markets. We've talked about this before, but we are always focused as things unfold on long-term implications. So we know that there's the possibility that we're in a new Cold War with Russia and with China, actually, and that just in general, there's an increased focus on military spending here in the U.S. and elsewhere, actually. We know that people are focused on increasing their energy independence. So Europe, for example, is working very hard to find alternative sources of energy so that they're not as dependent on Russia. Now, we also have seen really a much more unified NATO, and that I think came as a bit of a surprise to Russia and others. But the bottom line is that NATO has come together really in unity as it relates to dealing with this situation. And then everyone's watching, as we've discussed before, China's response. We think China's being very measured because they see themselves as having an important sort of role on the political, geopolitical, and economic stage. In any event, as it relates to markets, we've talked before about the idea that in past events, when this kind of thing has occurred, it's taken some time, but markets tend to recover. Now, we're in an environment where there are a lot of other factors in play, or factors that the war is sort of amplifying. So far, unfortunately, after about 3 months into this bad situation in Ukraine, markets remain down. So it's a big question as to when and how they'll recover. We do believe they will, but it's a matter of when. Now, I can't talk about volatility and the worries about volatility without touching on the pandemic. So here I want to point out a couple of things. The first is that we are seeing just a slight increase in cases here in the U.S., and I'm sure anecdotally everybody sort of probably has a story of family members or friends or themselves getting the virus. Fortunately, it doesn't seem to be as impactful, this latest variant. And the good news is that's in part because of the quality of our vaccinations here in the U.S. And that actually causes me to lead to the second point I want to make, which is, there's still a shutdown in China as it relates to their effort to fight the pandemic and fight the spread. One of the reasons that that's happening is that their vaccinations aren't quite as effective as those in the West, which means when people get sick, they get more sick. And there, of course, there's an increased mortality risk as a result. So more people getting sick, and those that get sick getting more sick. And so that's one of the factors that certainly is in focus is, how is China dealing with this, and when will they get through essentially the shutdowns of parts of their system to deal with the pandemic. Now, another thing that is weighing on people's minds for sure is inflation. So this page here basically shows a bunch of different indices, all very elevated. I will say that when it comes to the Consumer Price Index and Core Consumer Price Index, CPI, basically we've seen a modest, just a smidge of an improvement in the latest print, but still more to go. And we'll get into inflation in a little bit when we get into the macro environment. But bottom line is inflation is, of course, weighing on people. And one of the sort of dimensions to that is sort of captured on this next page, which is, basically which of the components of inflation might be transitory and which not, right? And so certain things can sort of bounce around and be more volatile and therefore come down more quickly. Other things takes a little bit more time. So it's a little more sticky, basically. In any event, when we look at the progression of inflation, this is a 5-year break-even inflation rate. It's a view of future inflation. We sort of framed it out, and some others have framed it out into basically 4 big steps. The first is normalization, as we've made our way through the pandemic and the reopening. Then essentially the reopening itself, driving demand, driving prices up. Then all of a sudden we had sort of supply chain challenges fueled and magnified by COVID variants. So the big jump from Omicron. And then this latest wave, to a good degree, is being attributed to the Russia invasion of Ukraine. And again, these are forward-looking measures. And so the idea that the forward-looking rate has sort of jumped in a stepwise fashion as a result of those 4 factors, for example, that's weighing on people. I mentioned supply chain. And so the good news with this chart, this is an index that kind of captures the pressure of supply chain. The modest good news is there's a little bit of a dip down recently, but the reality is even at this latest level, it's elevated, meaning that the pressure is up on supply chains. The system isn't working the way that it did pre-pandemic for sure. Now, another factor weighing on people is really around policy. So we had the fiscal policy efforts from last year and the year before. So big spending, maybe it's helping or contributing to is probably a better word, elevated inflation. But then there's monetary policy. We're going to talk a bit about this, but think of it as the Fed having to take action to rein in inflation. They're going to hike rates. They're going to reduce their balance sheet. And they want to try to do that while at the same time managing to the topic of this month. Can we get ourselves to a soft, or what they've called a soft-ish landing with the economy. So that's in keen focus, and it's on everyone's mind. People are pretty worried about it. So let's turn to the macro environment. So first, let's talk about GDP. So long story short, we all know that there was a big decline with the shutdowns, a big recovery, and yet what we saw in first quarter was a negative print of down 1.4% for U.S. GDP. So we don't think that'll happen for second quarter, which if it did would be technically a recession. We think we'll see a return to positive growth, and that the recession is probably out at the earliest, probably second half of 2023. In any event, here on this page, we are again reminded that the consumer is super important. And we're going to talk a bit about the consumer today. So let's start with sort of where things are. And this time around, we're comparing it to where they were a year ago. So to start with the upper left of this chart, basically confidence. So it's hard to know from these numbers, but 107.3 is basically a modest to somewhat negative print for consumer confidence. It was at 117.5 a year ago. And basically what we're seeing is things like inflation, things like the war, things like the worries about what's going to happen in DC, all that kind of thing is sort of weighing on the consumer. Even asset prices falling, of course, people are a little bit less positive because there's a lot going on. People are sort of focused on those things. Second, anyway, is retail sales. So growth of 8.2%, which actually is still pretty robust. So that means that by the current data, the consumer is contributing to the GDP. But when we look back to really what was the recovery year a year ago, 54.5%. That's a huge jump, of course, off of a low base from the shutdown of the pandemic. In any event, savings, 6.2%. That was 26.6% a year ago. Remember all the financial support from the government, so savings was way up. We still think there's a decent amount of cash on the sidelines, if you will, ready to be spent. In any event, a ray of hope here, unemployment down to 3.6%. A year ago, we were at 6%. Now, looking beyond just inflation at other factors in the economy, frankly, as it relates to just the current state of things and growth and signals of continued expansion, essentially we're in the green. So here we have our approach of presenting some of the latest data points, 9 in total. And you can see things like unemployment, which we just talked about, but ISM, which is a survey of business managers above 50, which means expansion. Business inventories up at 14.7, retail sales, which I mentioned, savings, which I mentioned. So all things are in the positive or modestly so. And so the only negative data point on this page is labor force participation, which we've discussed before. That's just really the recovery of the labor force as people are slowly, in some cases, getting back to work in the wake of people stepping away as the pandemic unfolded. Big debate going on whether inflation has peaked or not. So we have this article. You can hit the link on the deck if you pull it up. Bottom line is we think that in our case, we believe inflation is peaking, but it's going to take some time to fall. And the arguments for that is, number one, the base effect, that prices have gone up, but they may not continue to go up at the same pace. Number two, the potential for supply chain frictions to ease. Certain goods, prices on certain goods moderating, think of things like used cars, et cetera. And then importantly, of course, the idea that the Fed is taking action and they're wanting to slow things down enough to get inflation under control. In any event, things like the tight labor market, shortages, the war, China's zero COVID policy, and the idea that supply chains friction won't ease, those are all arguments that inflation will continue even higher from here. Now, what do the market metrics say? There's really two ways to look at it. One is to say, hey, let's look at break-evens. This is pricing on different kinds of securities that provide inflation hedge versus those that don't. You can back out what the market thinks inflation is out in coming years. And then on the right side of this page, these are basically estimates of analysts. And I think the punchline here is when we look out about a year from now, so on the left, it's that 1 year from now line, that first line. When we look out to the the full 2023 consensus view, it's basically about 3%. So the market and analysts are all forecasting a decline from where we are today down to about 3%, and then down to maybe 2.5% the next year. And so obviously the Fed has a target of 2%, so those are above Fed target, but well under control relative to where we are right now. Now, on the topic of recession, as I mentioned, we think the recession won't happen for a while, at earliest maybe second half of 2023. And this dashboard on this next page really kind of speaks to why we think this. We have these 13 different measures we're tracking. Essentially, a good number of them remain in the green, that we don't see yet a signal of recession. 5 of them do signal what we think of as caution, so something to watch, something to look at. So we know yield curve did flatten a little bit. That's one of the traditional signals. Money supply is up. We know that's a signal. Things like tight labor and wage growth, that's a signal, et cetera. So these are certain things that signal, hey, we have to be worried about it. But when we look at the entire data set, we think recession's a ways off. And that brings us to kind of where we are in the economic cycle. And the bottom line is we think we're moving into late cycle. So we still see the consumer spending. We see more credit being used. We see company profits starting to come under pressure. And then this shift, right, to mostly monetary, in this case, contractionary policy. And so long story short, we're moving towards the end of this economic cycle, but the recession's still a ways off. All this rolls up to these forecasts for 2022 and 2023. So think of it as decently above trend for this year, and then maybe a little bit above trend next year, but there's a variety of views out there. In any event, a key takeaway, which we've seen over the last couple of months, is these numbers are falling a little bit relative to where they were a month, 2 months, 3 months, 6 months ago. So everybody recognizes with the Fed taking action that things are going to calm down a little bit. Now let's turn to market implications. All right, interest rates, always a foundation to the investment side of the equation. And we see on this chart a number of metrics, and I want to just walk through each. Upper left, basically Fed funds. The flat line is long-term average. You can see that through the pandemic, we were basically near zero, and then a couple of moves, and then the orange dotted line is basically the forecast in terms of what the market's expecting from the Fed as it hikes rates. Now, the traded market, which is captured on the upper right, and this is 2, 10, and 30-year Treasury rates, basically trade in advance of the Fed, especially the short end. So you can see that 2-year rate just jump right up. The fact that it's kind of come to and sometimes exceeded the 10-year means that the curve is flattened. In any event, what that's meant, of course, is that interest rates have just generally climbed this year, which for people putting more money to work could be a positive, but for existing bondholders, of course, that means prices have declined some, and in a total return sense, that's a negative. In any event, we've talked about break-even inflation rising, which is the bottom left. On the bottom right, we can see corporate spreads. This happens to be on investment-grade bonds. And those have been tight for a good long time, kind of after the shock of the pandemic. And while they remain low, you can see they've jumped up just a little bit. So that's something we're watching very carefully, is whether spreads widen out. As it relates to the level of interest rates, we hear a lot from the media about this big jump. And of course, it does have an effect, right? Mortgage rates are up, credit card rates are going to be up. So the cost of debt is a little bit higher. But we just have to remind ourselves that relative to history, hey, we saw this level of rates back in 2018. So in terms of where interest rates could go, they could go a little bit higher from here. We're not calling for an aggressive move up, but we're still, relative to longer term history, at pretty low levels. Now, to take a transition from rates to equity, this is a chart that captures basically an analysis of the Fed hiking rates. So this obviously leads to market rates going up in a typical situation. And then actually to start talking about equities, we see the return on the equity market through each of those historic Fed rate hike cycles, and how long from when they started their rate hike cycle to when we saw a recession. So I think the punchline takeaway is two things here. Number one, through typical rate hikes, equities tend to perform positively. Number two, as they begin, it still takes time on average for a recession to unfold. So I wouldn't look at specifically the Fed rate hikes as a specific trigger for equity markets being and going lower. Anyway, to look more broadly at equities, here's an update to the chart for 2022. I will tell you that since developing these charts for this video, markets have traded off a little bit further, but think down maybe all in for the S&P 500 about 17%. And the bottom line is, though, the takeaway is the same, which is markets are weak here in 2022. And we have to decide, looking forward, where do we think things are going? We'll talk about that. But that's a give back from what was very positive performance, both in 2020 and 2021. So again, important to understand that when it comes to long-term investing, equities have earned a positive return. And of course, looking forward, we expect the same. Now, why has this been a particularly stressful year in the markets? One reason is the idea that the traditional diversified portfolio, it's sometimes called the 60-40 portfolio, 60% equities, 40% bonds, has kind of quote unquote broken down. And what that means is, hey, typically either you have both stocks and bonds in positive territory, or if one's in one's in negative territory, the other's in positive territory. So they tend to offset one another and be good diversifiers. 2022, when we look back at calendar years for a long time, this year so far, year to date, is the first time we're seeing a negative return from both components. And we'll see how it unfolds for the balance of the year, but that will be unusual. Right now, it doesn't mean we think this will be sustained. We actually believe, hey, that these are good diversifiers for one another. But even still, we've been saying of late, and saying for a while actually, it's never a bad time to talk to your advisor about diversification. This could be learning to diversify a little bit more within the asset class in which you're invested, or asset classes, or looking at additional asset classes to add to your mix. So again, the idea of diversification we think is positive. Okay, so now as it relates to where the markets are headed and whether it's a good time to invest, number one, I would say, hey, as it relates to being invested, if you're invested as a long-term investor, we say stay invested, stay the course. In any event, as it relates to kind of the sentiment out there, right now, there are many more bearish investors than bullish investors. And then as it relates to consumer sentiment, as we've discussed, this is actually a fairly low period by historic standards. What's important to note about both of these signals is that typically speaking, the equity market posts a positive and sometimes a very positive return in the coming 12 months off the base of that negativity, right? So of course, there's a lot of things driving equities at this point, but as it relates to this kind of analysis, it's sort of a fear-oriented environment, and oftentimes that's a good time to be investing. What that means is, hey, if you have money that you intend to invest, don't invest it all at once, but be methodical, disciplined, work with your advisor to invest a little bit at a time, but it's a decent time to be doing that. Now, one of the reasons we think that is when we look at valuation, you know, we've done a lot of things to try to understand this elevated PE ratio chart here on this next page. But of late, with the changes that we've seen in the market, in fact, with this most recent move, we've seen PE ratios basically decline and maybe even fall below long-term averages. So, you know, from a valuation perspective, basically markets have corrected a little bit. What's important, of course, is to understand where are earnings headed. So PE is a way to sort of relate earnings to price and where prices might go. And long story short, what we're seeing is earnings growth being sustained. This chart basically shows the consensus view on earnings growth for 2022, 2023, and 2024. And that consensus view essentially has growth for all 3 years in the kind of 8 to 10% range. Again, for each of those 3 years. And so that's a positive number as a point of reference. Our long-term assumption, what we think it will average over the long term, is 6%. So a little bit above our long-term average. In any event, I mentioned that, you know, there will be a recession at some point. The whole idea is when. Corresponding to that, eventually there will be a bear market. And so the bottom line is what we're reminded of on this next chart is that staying the course ends up paying off. So there are periods when we see the gray bars of recession. So that is often related to a bear market. And then inevitably there's recovery in the economy, and then ultimately the market. The market tends to move higher from there, and net, this visual tells us that basically the positives tend to outweigh the negatives. Another way to think about that is we expect over the medium to long term equity markets to post could be a modest but a positive return nonetheless. Now let's turn to our dynamic leanings. And these are important because they do reflect kind of some of our views looking forward. They're based upon, of course, a framework for asset allocation. So that idea of being a long-term investor is often what's called strategic asset allocation. We're big fans of that. Our asset allocation guidance and structure speaks to that. But we know people are interested in shorter-term dynamic leanings. So let's jump into those. It really, I would say, what's interesting about it is we're staying the course on our dynamic leanings. They relate to a view that we're in a period still of economic growth and recovery from the pandemic. So we're overweight non-U.S. stocks. Within the U.S., we remain overweight value, and for those that use active management, overweight small cap. All of that, again, sort of anchored in the idea of further recovery. But we also know that with this sort of strained environment, it's a decent time to be thinking quality. So we tend to lean in where we can to quality-based investments. Companies that are financially a little bit stronger can weather some of this volatility, that kind of thinking. On the fixed income side anyway, we're modestly overweight for those that use active management, high yield, and we'll be reviewing that. But the bottom line is with some of those changes in spread even, we think it's a fertile environment for high yield managers to find extra value. So again, for those that have exposure to high yield, not a bad time to be modestly overweight. I'm going to close out often where I do to just invite you to, on this last slide, if you pull up the deck, check out all of our work. All these links are live, and you can hit any of them and go check it out. But thank you so much for listening and watching this month, and we'll speak with you next month. Thank you.